Okay, so welcome to our webinar this month. So how did this topic come about? I was reading in my Bible, Proverbs 13, verse 22, and it says, a good man leaves an inheritance to his children's children. As I said, that got me thinking. So leaving a legacy for future generations is a timeless principle. I think most of us can agree with that. While financial inheritance is significant, it's also crucial to teach children how to manage wealth responsibly to avoid losing it. I think that's where we fall short on that part. So true wealth includes imparting wisdom about the value of hard work and fiscal responsibility, and obviously how to work with money. So beyond wealth, I believe there are three invaluable inheritances, such as education or financial literacy, common sense, and generosity. So welcome to our webinar this month. Those of you that don't know me, my name is Sean van den Berg. I'm investment specialist at PSG Wealth. So my whole objective of this webinar today is to discuss the importance of responsible stewardship, another biblical term, but also how it benefits the next generation. Okay, so with that in mind, it's just those of you that have children, be prepared to have these conversations. Okay, so here's my call it agenda. Okay, my 3 parts always, but the idea here today is that, and as I say, I got me thinking, and I was asking this question to myself. I've got a 17-year-old son. Do millennials and Generation Z, generations, do they take advice? Do they take investment advice? So the younger generations are far more likely to turn to their parents, and I was quite surprised when I read that, or to online for financial advice than the older generations like myself. I'm a baby boomer, and obviously the Generation Z, they're more inclined to take information online, going online to look for information. I see that with my son, 17 years old. He hates school, but he's taught himself how to program and things like that from what I call in the YouTube University. So he likes to watch videos and things like that. And I think that's a lot of his generation would do that. So the main thing is, you have to start understanding the millennials and the Generation Z. So unlike the previous generations, millennials, these are the guys born between the early 1980s and the mid 1990s. They've grown up during significant societal changes. They differ from us baby boomers and generations X in the sense that they one of the bigger features they have is they have the ability to adapt and evolve. So they've been involved in a world that has witnessed unprecedented technological changes. So they're also more, call it flexible thinkers, and are often more open-minded than other generations. So understanding that our Generation Z, these guys are born between 1997 and 2012, so roughly looking at between the ages of 12 and 27 at the moment. These guys are commonly referred to as the digitally native generation. So these are the guys that are living on social media and on their smartphones. In other words, they're living in a digital first world. Okay, so that gives you a bit of context what this whole presentation is about today. So let's talk about our first little topic here. Focus on the things that you can control. The reason why I put this in is, we can enjoy above average performance as an investor over the long term by focusing on things that we can control or predict, and being patient and keeping things simple. Those are that's just common sense, I would say. But sensible investment rules such as diversification, we have spoken about this before in previous webinars, diversification and rebalancing, and obviously adapting again to the long-term approach are more is not only prudent, but also well, let me put it this way, it is prudent because financial markets and human behavior are unpredictable. So sensible investing will give you the results over the long term, but obviously it's boring. Warren Buffett once said that making money is like watching paint dry. That has to be boring. Okay, so it's important. If it's important for you to match a index or a benchmark, and that strategy includes trying to predict the markets or certain events, I can tell you now it's going to be quite hard in the sense that it's out of your control and you're basically hoping on luck, which is not a good way to look at investing. So you don't need to be in control. You don't need to be predict the unpredictable. We're going to talk about it in the next few slides. If you have a goals-based portfolio or investment plan, and follow a rigorous, call it rebalancing program, you will be able to be successful. When we have stock market corrections, last month we spoke about being in the market for the long term. Now, when there's stock market corrections, and those are opportunities, to get into the market. So saying that, let's get into it. Things that you do not control over. First of all, there's three things: the stock market, short-term movements in individual shares, and obviously your investment returns. That's very broad. I'm talking about share market in general because obviously that's our main investment vehicle. So markets move up and down, and sometimes nobody knows why. And we have an old saying in the market: if the market's going up, there's more buyers than sellers. The market's going down, there's more sellers than buyers. Supply and demand. Demand's going up, the demand is exceeding supply, and vice versa. Supply is greater than the demand. Okay. But saying that, we have to look at who are the players in the market. We have a whole lot of different individuals. We've got portfolio managers, we've got unit trust funds, we've got institutional investors, we've got the private investor. All of us have different goals and dreams, okay? We do not all have the same goals in the same day, okay? So every time we buy and sell, there's a willing buyer and a willing seller. Someone has the opposite opinion. One of them's wrong, yeah? So that's the market. So bottom line, you do not control market sentiment. So that's number one. Number two, the individual shares. If you think the whole stock market is crazy, imagine the individual shares. Sometimes the market goes crazy, one particular stock, and the rest of the market goes down. So there's a lot of factors that can affect a share on a particular day. We talk about earnings and call it trade updates and earnings announcements and earnings revisions from the analysts and the analyst opinions and a whole lot of different factors, fear and greed and supply and demand. A lot of factors can move the share price up and down, okay? But again, what's important is that you do not have control over that. You're laying the decisions at the collective market, at the feet of the collective market and its participants. Yeah, that's what moves the market. And lastly, there, your investment returns. Since the financial crisis, I mean, it's way back in 2008, the JSE boasts roughly about 12.5% annualized return. But saying that, you don't just walk in the 1st of January and on the 31st of December expect 12.5%. It's not a straight line. So returns are all over the place. So again, bottom line, you can't expect to control your investment returns, or they will control you. So those are just some things that you cannot control. Let's talk about a few things that you can control. So first of all, setting financial goals. We have spoken about this a lot of times before in previous webinars. Having a goals orientated investment approach. I might sound like I'm a Tony Robbins here, but the main thing is, ask yourself a question: why? Why is retirement important for me? Why is having an emergency fund important to me? So it's not so much the numbers and things like that. It's also understanding the why. Okay, why is having an education plan, things like that, and then figure out a strategy. Are you going to focus more on growth, capital growth, or is it more a combination between capital and dividend reinvestment, whatever the case might be? Okay, and then obviously setting up those goals to match your risk profile, match your time horizon and things like that. All things that we have spoken before. Yeah, you can also look at things like what's important is the asset allocation. This, I believe, is one of the most important things to look at. It's all about risk management. Yeah, so keeping a balanced and diversified mix of investments. You want to spread it around. Again, depending on your risk profile, the younger you are, the more risk you can take on. And the older you are, obviously you have to be a bit more aware of the risks. So the younger you are, take on more risk, have more exposure to the share market. Some of you might be more aggressive. Some of you might be a bit more moderate. Some of you might be a bit more moderate to aggressive. So it depends on your risk profile. But your time horizon also dictate that. Okay, so we have spoken about these things a lot of times before. Okay, but it's all having a disciplined investment process, and that's what's important, is rebalancing your portfolio maybe once a year or maybe every 6 months back to those acceptable ranges that we had before, and then keeping your emotions in check. All of us think as we are good at making investment decisions. But when the market's volatile, there's a lot of uncertainty, and that's where we get unstuck. Okay, so do not allow fear and greed to overtake your decision-making process. Again, it's important to have an investment plan in place. The more comprehensive your investment plan, the better. So it's anticipating these things in the future. What are you going to do? And then sticking to that plan through thick and thin. Okay. I have spoken about this also in previous webinars, but a trader has to have a trading plan the trade and trade the plan. It's the same thing, you have an investment plan. Okay, so these are the kind of things that you want to discuss with your children or future generations, as having all these things in place. And then what you can also control is minimizing the fees. Okay, so we don't have how can I say it, initial fees. A lot of those things are being phased out anyway, and the move is towards, all funds are moving to what we call clean class. It's just easier to compare funds in that. But here's an example of what we call the admin fee, or the monthly platform fee. That's what PSG charges. You can look at it as a comparison. Okay, and then also what's important is taxes. I'm always amazed that people don't consider taxes, because at the end of the day, you want to minimize the taxes and obviously maximize your growth. So be aware of more effective investment vehicles, like a retirement annuity, like a tax-free. Use it to your advantage. Okay, if you have investments that are not so much tax efficient, be aware of what the tax implications are. Okay, so those are just some of the things to highlight for you. Let's talk about 5 investment principles. And I have spoken about the basics before, in the sense that what do you call it? Starting early, take advantage of magic of compounding. Okay, we've spoken about that before. We've spoken about the investing regularly, taking advantage of rand cost averaging. We have spoken before about diversification. We just touched on it just now. We've spoken about it also where having a financial plan. So these are the basics, but I want to go into a bit more, some extras, if I can say that. So first of all, invest in what you know. And I believe this is what's also important. Right up top there, you see one of the most important rules: always do your homework, always do your research. Understand what, first of all, what's the product about, the investment product about, and then secondly, what are you investing into? It's dangerous to follow the crowd. Okay, you might be caught in a bubble, and obviously that's where prices fall. So you want to buy into good quality companies that generate strong cash flow. I'm talking now about a direct share portfolio. When you're doing your homework on a unit trust, same thing. Look at the company, at the fund manager's performance. Look at how they performed in the past. Yes, we know that past performance is no indication of future performance, but look at the long-term performance. That gives you an idea. Okay. And then patience, and I think this is for the next generations. I think that's what they're going to lack. So we need to teach our children to be patient. Especially if you're working on long-term goals, you need patience. Okay, remember the market fluctuates up and down daily. It's not worried about what's happening daily. It's a long-term picture. Okay, so yeah. And then value is important. This is again going to get back to Warren Buffett. Some of you might have heard of Warren Buffett saying this before. Price is what you pay, and value is what you get. Yeah, so no matter how wonderful the company is, if you're overpaying it, the market's cyclical. So if you're buying the top of the cycle, as I say, you're buying from someone that's selling. He has the opposite opinion. He thinks the price is going down. You think it's going higher. Okay, so you don't want to be overpaying for a share. So there's various things we can use. We're looking at shares. We look at price earnings multiples. We look at price NAVs. Compare the share price to its intrinsic value. All those kind of things help us make a more informed decision. So the whole idea here is obviously you want to buy shares that are undervalued. This is more the value approach, bargain hunting. You get more upside potential, but also on the other side, you have greater what they call marginal safety, and which reduces the risk. So that's important. Value is important. And then time in the market. We spoke about this in the last month's webinar. Time in the market beats timing the market. All of us trying to get out of the market when the market turns, which is not very good. You're going to miss out on a lot of opportunities. The best performing days is just afterwards we have a downturn. You look at back to March 2020 when we went into hard lockdown with COVID, how the market recovered from that. So a lot of people were stuck on the sidelines in the money markets for more than a year. They missed all those opportunities. Okay, so no one can consistently predict the market turning points. So rather stay in the market through thick and thin. Okay, that's why they have that long-term view. And then lastly, be fearful when others are greedy, and greedy when everyone else is fearful. Again, that is from Warren Buffett. He made that quote way back in 1986. So basically, again, avoid following the crowd. You want to be a bit of a contrarian. When everybody else is selling, you want to be buying, and when everyone else is buying, you want to be selling. Okay, so it's just a opposite way of looking at the market. Gives you the opportunity to buy shares when everyone else is dumping the stocks. Okay, you're doing your homework and think these opportunities. You're buying to the company, and when everyone else got on to the idea that this is a valuable company, the share price will go up. Okay, and that's when you want to be selling. Okay, so that hopefully gives you some ideas. So let's talk about how will the next generation invest. Now, I found this was interesting when I was doing my research on this, in the sense that, again, our millennials and the our Generation Zs, these are the guys that are, it's more the Generation Zs, but they're obsessed with being rich, if I can put it that way. There was a research, some research done that said that 45% of millennials found that they were obsessed with being rich, whereas the Generation Z's they just felt they were behind financially. Why? Because they live on social media and they're comparing themselves to these celebrities and all these other influencers. And that was quite interesting when I saw that. So again, these guys have access to technology, so they will have a fresh perspective to investing. Things are changing there. They will be leveraging technology, leveraging innovation. So yeah, first of all, they will be thinking and investing differently. So apart, beyond, we put it that way, beyond seeking financial return and building personal wealth, they want a bit extra. They want to be investing that aligns with investments that align with their values and passions. Again, as I said, they were looking at using technology. They will be focusing on more of the environmental and social justice issues. So all those things we've spoken about before, ESG, environmental, the social, and the governance that become more and more prevalent. So there's inclination for them to be less involved in traditional investments like shares and bonds, and drawn more towards alternative investments, things like cryptocurrencies, real estate, crowdfunding. You can call it more like a investment club there, but it's yeah, compared to property syndication, obviously this is a bigger number of investors with a smaller outlay compared to property syndication. But the main thing is they want to focus on impact. They want to make an impact on the world, and what is important for them. So that impact investing is important. And again, they want to be aligned with their values. They want to be avoiding things like, how can I say, the fossil fuels and the tobacco and all that kind of things. Yeah, so it's more becoming more socially conscious investors. Okay, and as I mentioned just now, impact investing. They are passionate about making a positive impact on the world. They are drawn to companies and funds that are prioritizing ESG criteria. Again, they're looking for companies that they're going to contribute to more sustainable future as such. Okay, so there is more and more interest in this whole sector. It is growing. So there will be more and more investment products coming online for this and catering for these investors. And there's obviously more the move towards initiatives like affordable housing and renewable energy and education and healthcare. All that kind of things is where they will be focusing on. Okay. And also, I found it interesting that these guys are focusing on more of the small businesses and entrepreneurs, especially companies owned by women, minorities, and individuals from disadvantaged backgrounds. So yeah, that's where the focus will be shifting. So big move from our normal traditional investments. And then lastly, as I mentioned just now, this whole role of fintech, using apps and things like that. We've seen how AI has already made a big impact on the internet, social media especially. We've seen also robo advisors. We've seen how blockchain technology has come about, as well as obviously there are a slew of mobile trading apps on the market right now. So yeah, it has call it democratized, or made the playing field even. It's easier for these millennials to get access to information than before. They can do all their research, they can trade, and they can manage their portfolios from anywhere in the world from their cell phones, from their smartphones. Okay, so it was also interesting to find out that social media plays a big role with these millennials and Generation Zs. They look a lot at what's happening on TikTok, and I mentioned just now about YouTube University. They learn a lot from that. So they're 5 times more likely to make the investment decisions based on what they see on social media. So things are changing slowly. So focusing on what the celebrities are doing and what these influencers are doing, that's how these guys make the decisions. Okay. So yeah, they also demand more transparency and more flexibility in their tech. So a bit more demanding on that side, but also they'll be looking at more lower fees and more personalized advice. So things are slowly changing that. So guys, I hope that gives you a bit of insight to what kind of advice, how you have to start positioning yourself to give advice for the future generations. So in quick summary, the things you can control, that you have no control over again, is the stock market, individual companies, and your investment returns. The things that you do have control over is obviously setting goals, how much you save, asset allocation, your emotions to a certain extent. I believe also when it comes to emotions, it's just having everything on autopilot. That's the easiest. Minimizing your fees, your costs, and then obviously minimizing your taxes to maximize returns. And then again, we spoke about just now these top 5 investment principles. Invest in what you know. Be patient. Value is important. You don't want to be overpaying for a stock. Time in the market, and then be fearful when others are greedy, and in other words, being a bit more contrarian. Okay, so I went through that very quickly. Let me see what kind of questions you guys have. Okay. There's a question here from Howard, and Howard wants to know, do we have a demo trading account? Howard, no, we don't have a demo trading account anymore. A simulator. We had that many years ago. The idea of the simulator was for you to play around with play money, Yeah, and people used to get a false sense of security. Oh, I can make money in a simulated environment. I can do it in a real market. Nah, it doesn't work like it because there's no emotions involved. So I presume this is a question that you look for I presume for your child. Open up a trading account for them in their names. Don't fund it. They have access to the trading platform, things like that. They can place orders way out of the market. Nothing's going to happen. So they can gain experience that way. They can create watch lists of the companies that they'd be interested in. They can look at the charts. They'll have access to research. Yeah, and then slowly let them, read books. I don't know, they read so much books now. But read books, look at websites. There's Investopedia, a lot of websites that can teach you about trading and investing. There are a lot of YouTube videos you can look at, and then slowly, build up the capital and start investing. So that's how I suggest. But to answer your question, no, we don't have a demo account. Here's a question from Shepo. I want to start a education plan for my baby daughter. What is the best investment product? Great question. I would say offhand, if it's a baby daughter, I presume it's got at least 15 years ahead of her. I would suggest maybe the tax-free investment plan, because as it implies, any growth, capital growth, income from interest and dividends are all tax-free. So also depends on how much you want to invest. There is a lifetime limit of 500,000 from a contribution, but annually it's 36,000 at this point in time, 3,000 Rand a month. So if you want to invest more than 36,000 a year, maybe consider a voluntary investment plan. But I think that'll suit most people's needs. Is putting either a lump sum away every year, 36,000, or I'll take advantage of rand cost averaging, 3,000 Rand a month. Yeah. So I hope that answers your question. Yeah, because 500,000 divided by 36,000 is roughly about 12, 13 years. So yeah, then she'll get around to getting close to university. Remember, that's just the contributions. You still got growth on top of that. Alternatively, look at the voluntary investment plan, gives you more flexibility, greater funds, a wider range of funds to choose from. Okay, doesn't look like there's any other questions. Okay, cool. So in conclusion, yeah, guys, these are different investment products. As I want to highlight, do your homework. What is the best investment vehicle for your goal? As I mentioned now to Sepo, is that gone the wrong way. The tax-free investment plan or the voluntary investment plan. And as soon as you start working, as soon as your child starts working, they must probably have access to a pension or provident fund through a company. But also start a retirement annuity. You can start those 500 Rand. Okay, so it's definitely the earlier you start, the better. And we are flexible. If things are tough, you stop your debit order. Yeah, I always say about the retirement annuity is forever savings. You can't take money out. So it's one way to force yourself to plan for retirement. So that looks like all the questions, guys. But from my side, thank you very much for being on this webinar again. There's my contact details. Contact me on the email wealth@psg.co.za. You also can find me on the OneStream number there, 0860 000 368. So guys, from my side, thank you very much for being on this webinar. Can't believe it's halfway through the year already. We'll talk again the last Wednesday of July. All the best. Bye for now.